Hi guys! So I was reading this article about Singapore's core inflation easing to 1% in January 2026. And I realized something most buyers and upgraders are completely missing. So the latest inflation numbers that came out this week are actually telling us something very specific about where this market is heading. And if you are planning to buy, upgrade, or hold in the next 6 to 12 months, this is something you really need to hear. Today, I want to share 3 takeaways that I'm seeing in the Singapore property market right now. Let's go. Takeaway number 1 is inflation is cooling down, and that is directly lowering your borrowing cost. So NES core inflation just dropped to 1% in January 2026. The month before, in January 2025, it was at 1.2%. And the headline CPI, which includes everything, came in at 1.4% in January, up from 1.2% in December. Now, what does this have to do with property? Now, when inflation moderates, it reduces pressure on interest rates to stay elevated, and that is already showing up in our mortgage market. Right now, 1-month compounded SORA is sitting at about 1.1%, and 3-month compounded SORA is about 1.12% as at February 2026. So with typical bank spreads added on, your all-in floating home loan rate is roughly 1.9 to 2.4% per annum, depending on your package and bank. For fixed packages, DBS is currently offering a 3-year fixed rate of about 1.78% per annum. Then it reverts to SORA plus spread from year 4 onwards. So right now, we are clearly in a low rate cycle. Now let me show you what this means in actual dollars. So say you are looking at an OCR new launch condo price around 1.35 million. Now, which is a very realistic entry level price in OCR today for a 2-bedroom unit. So let's assume the loan is at 75% LTV. It gives you a loan of about $1.01 million. So on a 25-year loan tenure at around 2%, your estimated monthly installment is roughly $4,280 to $4,400. Now, I always stress test every client, because what if rates climb back up to 4.8%, which is exactly where SORA-based mortgages were just 2 years ago. At 4.8% on the same $1.01 million loan over 25 years, your monthly installment rises approximately $5,750 to $5,900. That is a difference of about $1,400 to $1,500 every single month. Now, this is not meant to scare you. This is how I want you to think about your affordability. Not just at today's rate, but at a realistic stress level. Because if your household cash flow can absorb that buffer comfortably, then the current rate environment is genuinely one of the better windows you will see this cycle. And for my second takeaway, accommodation inflation just spiked, and that is quietly pushing HDB upgraders to act. So here's the interesting twist in this data. While the core inflation dropped to 1%, the accommodation inflation actually surged from 0.3% in December to 1.9% in January 2026. And the main driver was higher housing maintenance and repair costs. Now, this tells us something very important about owner costs. If you are sitting in a resale HDB flat right now, especially one that is 10 to 15 years old, your maintenance and upkeep or outgoings are going up. Real money going out every single month. And at the same time, a lot of HDB owners, especially those in 5-room flats in towns like Punggol, are sitting on very significant paper gains. So let me give you a real scenario. A couple bought a 5-room HDB flat in Punggol around 2015 to 2016 as a BTO, probably paid in a range of $330,000 to $380,000. Today, the median 5-room HDB resale prices in Punggol are around $580,000, and strong transacted prices are reaching $620,000 to $780,000. So their outstanding loan may be around $180,000 to $230,000 at this stage. So that means that their net cash proceeds after CPF refund and loan redemption could realistically be in the range of around $350,000 to $450,000, depending on how much CPF was used. This couple could co-fund the purchase of an OCR private condo in the $1.3 million to $1.5 million range, using CPF OA proceeds for the down payment and keeping their cash reserves relatively intact. So the question is not just whether they can afford to upgrade. The real question is, what does that equity do for them if they wait another 2 or 3 years? Does it compound inside a private property with demonstrated capital appreciation? Or does it sit in a savings account earning only 2 to 3% while new launch OCR condo prices edge towards and beyond $2,400 per square foot? So this is the conversation that I have with upgrader clients every week. And for my third takeaway, we are in an early low rate cycle. This window is real, but it will not stay open indefinitely. Right now, the 3-month compounded SORA is at 1.12%, and some bank forecasts project it settling around 1.39% by the end of 2026. So that is a very different environment from where we were in 2023 and early 2024, when SORA-based all-in rates were hitting 3.5 to 4%. And here is what I've consistently observed about buyer behavior across rate cycles in Singapore. Because when rates are high, say 3.5 to 4%, buyers tend to hesitate. They wait. Transaction volumes tend to slow down, and that is exactly what happened in 2023 and 2024, when new private home sales for the full year 2024 were around 6,469 units for the full year 2024. And when rates dropped and conditions improved, new private home sales in 2025 surged to 10,815 units, a 67% year-on-year recovery. The market responds very quickly once buyers feel the affordability shift. And if you look at where prices are heading, Average OCR new launch prices are expected to reach around $2,400 PSF in 2026, up from about $2,263 PSF in 2025. RCR new launches are already averaging $2,400 to $2,800 PSF. So let me run one more installment calculation. Take a $1.5 million RCR condo. Loan at 75% is about $1.125 million. At today's effective rate of about 2% over 30 years, estimated monthly installment is roughly $4,160 to $4,300. Stress test at 4.8%, monthly climbs to approximately $5,850 to $6,000. That is a buffer gap of about $1,550 to $1,700 per month. Now for a dual income household, the combined gross income of $12,000 to $14,000 a month, and especially once you factor in rental yield potential, this is a financially sound structure. For a single income household, this is exactly where sitting down with a property advisor to map out the full financial picture becomes non-negotiable. So here's the macro picture. MPI and MAS are keeping the full year 2026 inflation forecast at 1 to 2%. That signals clearly to the market, no aggressive rate hikes are expected this year. So the conditions are aligned. Rates are low, transaction volumes are recovering, and price floors in both OCR and RCR are trending higher. So the question is not simply whether this is a good time to buy. The question is whether you have structured your finances correctly to take advantage of this window before it closes. Have you reviewed your current loan package recently? Have you stress tested your affordability at both 2% and 4.8%? And if you are sitting on HDB equity today, have you mapped out what that equity could do inside a private property over the next 7 to 10 years? These are conversations that actually move people forward in their property journey. If you want to explore how any of this applies to your own situation, whether you are a first-time buyer, a HDB upgrader, or an investor thinking of your next move, you can DM me, WhatsApp to me, or just drop a comment below and I will personally reach out. So this is just my personal opinion based on what I'm seeing in the Singapore property market right now. It is not financial advice, so please do your own checks and research accordingly. Thanks for watching. See you guys in the next video.